Futures run 23 hours a day, but only one of those hours really matters. Here's the liquidity map.
The futures market runs 23 hours a day, but only one of those hours really matters. Here's what I mean. The S&P 500 E-mini opens Sunday at 6 p.m. Eastern, runs almost non-stop until Friday at 5 p.m., and pauses for exactly 1 hour each weekday in between. 5 sessions a week, 23 hours per day. Sounds like a trader's dream, until you look at where the volume actually sits. Roughly 25 to 35% of the entire day's ES volume, the most liquid futures contract on planet Earth, hits the tape in the first hour after the New York cash open. 1 hour, a third of the day. The other 22 hours are open. They're tradable in theory, but the book is thinner, the spreads are wider, and a surprise Bank of Japan statement at 10:30 at night can shove Nikkei futures 2% offside before the headline even fully prints. Open and tradable are not the same word. Here's the map. Start with the part most traders get wrong, the daily pause. Every weekday between 5 p.m. and 6 p.m. Eastern, CME Globex stops accepting new orders and stops matching. 60 minutes of nothing. Why? Not regulation, it's housekeeping. The exchange needs that window to settle the day's trades, calculate end-of-day margin against a volume-weighted closing price, and roll the session forward. When 6 p.m. hits, the new session opens. And the reason it opens at 6 p.m. specifically is Tokyo. Asian markets are about to wake up. Futures have to be live for them. Here's what actually changes during that hour. Day orders die at 5 p.m. Cancelled. GTC orders go to sleep and re-enter the book at 6. Your positions don't move. They roll straight into the next session, but your margin can. CME publishes maintenance margin updates that take effect at the new session open. If volatility expanded that day, your overnight requirement is higher than your intraday one was. Remember that number. It's bigger than most retail traders expect, and we'll come back to it. Back to the liquidity map. Forget the 23-hour headline. Think of the futures day in 4 windows. Window 1, 9:30 to 10:30 Eastern, the US cash open. A quarter to a third of the entire day's ES volume hits inside that single hour. This is the deepest book in the world. Window 2, 3 p.m. to 4 p.m., the close. Also heavy. Closing flows, hedgers rebalancing, end-of-day algos. Window 3, roughly 3 to 5 a.m. Eastern. Europe wakes up. Secondary peak. Real volume, but nothing like New York. Window 4, 6 p.m. to 2 a.m. Asia, thin, genuinely thin. 3 things suffer in those thin hours: slippage, stop runs, and macro events. Slippage gets bigger because the book is smaller. Your stop hunts further to find a fill. Stop runs are easier to provoke when only a few hundred contracts sit on each level. And news that lands in thin hours moves further than it should. That BOJ statement at 10:30 p.m. Eastern is the textbook case. The print drops, the screen empties, and Nikkei futures gap 2% before the algos finish parsing what was said. Compare that with a US CPI release at 8:30 a.m. Eastern. Same magnitude of news. Spreads widen for 30 to 60 seconds, then liquidity floods right back in. Same shock, different damage. Because of when it hits the clock. The same logic explains why crude reacts hardest on Wednesdays at 10:30. The EIA inventory print drops in the most liquid window, and why gold pivots cluster around the London 10:30 and 3 p.m. fixings as they overlap New York. Liquidity creates the move. This is where the 23 hours rule starts to lie to you. Not every product follows the equity index template. CBOT grains, corn, wheat, soybeans split the day in 2. Electronic overnight from 7 p.m. to 7:45 a.m. Eastern, then a day session from 8:30 to 1:20 p.m., then a long afternoon break that lets the physical cash grain market process price discovery. Livestock is even tighter. Lean hogs, live cattle, feeder cattle run a single day session, roughly 8:30 to just before 2 p.m. Eastern. That's it. No overnight session at all. Eurex, the Frankfurt exchange, home to DAX and Bund futures, runs Monday to Friday and skips Sunday evening entirely. Its trading week starts Monday morning European time. ICE softs, coffee, sugar, cocoa, cotton, orange juice, each have their own window. The orange juice clock isn't the cocoa clock. And crypto futures? Here's the trap. CME's Bitcoin and Ether futures mirror the equity index template. 23 hours, weekdays only, even though spot Bitcoin trades 24/7. That weekend gap, Friday 5 p.m. to Sunday 6 p.m. Eastern, is real. Spot can move 10% while the futures contract is closed. You reopen Sunday evening into a price you couldn't hedge. 3 traps eat retail futures traders who don't check them. First, overnight margin. The thing I told you to remember. Many futures brokers raise the per contract requirement 5 to 10 times the intraday rate outside the US cash session. That's not a typo, 5 to 10 times. If your account can't carry the higher requirement at 5 p.m., the broker liquidates you into the next session's open. Always check the schedule before you hold through the pause. Second, time zones. CME quotes everything in Eastern time. If you trade from London, that's a 5-hour offset in winter and 4 in summer, because the US and Europe shift daylight saving on different weekends. 4 times a year, your trading clock moves and the conversion changes. Third, contract rolls. Equity index futures roll quarterly: March, June, September, December. On the roll date, liquidity migrates from the front month to the next month. If you only day trade and close every position by the bell, you can ignore this. If you hold overnight anywhere near a roll, being long the wrong month is a real expensive mistake. And one detail that catches people sizing up: tick value. ES is $50 per index point. The micro, MES, is $5 per point. Same chart, 10 times the risk per contract. Add the 2026 holiday calendar on top: Good Friday, Juneteenth, the early close days around July 3rd, and Christmas Eve, and you have 4 separate clocks to track: equities, energy, grains, ICE. So back to that Bank of Japan statement at 10:30 p.m. The reason it can shove Nikkei futures 2% offside isn't that the news is bigger than US CPI. It's that the book is empty when it lands. That's the whole lesson. Open is a clock. Tradable is a liquidity question. 3 rules to take away. 1. Trade the liquidity, not the hours. The first 60 minutes of the New York cash session is where the depth lives. If you scalp ES or NQ, that's your window. 2. Before you hold a position through the 5 p.m. pause, pull up your broker's overnight margin schedule. 5 to 10 times intraday is not unusual. Make sure your account can carry it. 3. Verify the contract spec for the exact product you trade. Grains, livestock, Eurex, ICE softs, and crypto don't follow the equity index template. The CME holiday calendar and your contract spec page are the 2 tabs you want open before the next session prints.
Trade the liquidity, not the clock. Full breakdown linked in the description.